plans, most employers have a medical insurance or other benefit classification group, and typically a deferred compensation group or plan is within those. Qualified plans, both pension and profit sharing plans, are aimed at providing employees with retirement income. They approach the goal in different ways, though. Qualified pension plans can be categorized as either defined benefit plans or defined contribution plans. A defined benefit plan is designed to provide employees with a certain level of benefit during an employee's retirement, a level generally based on the employee's age, compensation level, length of service. Your profit sharing plans are a defined contribution plan that gives the company, where the company also will match in certain amounts that are designed specifically for those employers to calculate what they want to contribute. An after-tax contribution plan, that's when you hear the term Roth. An employer may permit employees to participate in a benefit program if they pay the cost of the benefit dollars available after taxes are deducted from their pay. Any benefit may be purchased by the employees through deduction from their wages after tax. So take a look at this example. The point of the after-tax information is knowing exactly where that deduction comes out of an employee's pay. For the after-tax deduction, you'll see that that $30 for this particular example is deducted just directly above that net pay amount. In a pre-tax contribution, the amount is taken prior to their taxes. So you still pay the full Social Security and Medicare, just like you would out of an after-tax. The only item that is affected would be that federal income tax withholding. So in this particular example, you would just want to pay attention to exactly what they're asking for in the question or in the example, and where those wages are going to be subjected to that contribution. This particular one, because it's a pre-tax contribution or deferred compensation payment, you take that out of their gross wages before you even calculate what that federal income tax withholding amount would be. Crucial to pay attention to. Pop quiz. Calculate this employee's federal income tax that would be withheld on the employee's monthly 401k deferral. This employee earns $4,500 per month, defers 3% to a 401k plan. Employee is paid semi-monthly, and as the test tip points out, keep in mind, sometimes these pop quizzes and questions on the CPP or FCP, they'll give you unnecessary information just to try to trip you up.
And remember, and for those who are new, to get your RCH credits, please make sure you are answering these questions into the chat function so we have a record of your participation.
I'll give you all a couple of seconds to answer. If you came up with $10.33, you would be correct. So you're calculating in this particular example, you are only calculating the federal taxes that would be withheld on this 401k deferral. So you would take 3% of that $4,500. And because it's a 401k plan, there is no federal income tax withheld. You would just take Social Security and Medicare. So the 0.062 and 0.0145 out of the 3%, that answer is $10.33. So, deferred compensation. Employers can provide their employees with a variety of deferred compensation plans. However, salary reductions into a deferred compensation plan are subject to Social Security and Medicare. Regardless of anything else, you're still always going to pay that Social Security and Medicare. These plans are designed to defer the employee's wages until they retire, when the individual will presumably be in a lower tax bracket. In effect, these deferred compensation plans provide employers with the ability to set up a retirement plan for an employee with really minimal cost to the employer. Types of qualified deferred compensation plan would be a 401k or 403b. Your non-qualified plans don't meet the same requirements of the IRS regulations. They delay taxation for federal income tax purposes. The majority of them are also provided to employees with some benefits of a qualified plan by, pardon me, I'm going to rephrase that. They provide employees with some of the benefits of a qualified plan by delaying the taxation, but there is a significant chance of higher risk of loss for those deferrals and more restrictions on elections of deferrals and distributions from those plans. They're typically considered non-qualified because they do allow discrimination in those plans. Discrimination meaning like for your highly compensated employees. Defined benefit and contribution plans may not base benefit accruals or contributions on an employee's compensation in excess of that annual compensation limit. So every year, these are things that you're going to want to pay attention to because those limits change annually for the compensation limit as well as the potential annual contribution limit. Contribution limits under the IRC 415 is the total of all employer and employee pre-tax, after-tax, Roth on behalf of the employee cannot exceed the lesser of $57,000 in 2020 or 100% of the employee's compensation. So for those higher compensated employees, you still need to pay attention to that $57,000 limit. The tax treatment of pension and profit sharing. Yeah, here. I skipped my pages. When certain requirements are met under the IRC 401A regarding employer contributions are excluded from wages and not subject to federal income tax, FICA, and FUTA taxes. Those cases are when, with participation, vesting that is a non-forfeitable right to benefits, contribution limits, benefit limits, non-discrimination in favor of highly compensated employees, the employee after-tax contribution to a qualified plan are generally included in income, subject to all federal income tax, federal FICA, so Social Security and Medicare, FUTA taxes. Also, your payments from plans are taxable when received by the employee when they retire. The portion of after-tax contributions are not taxable. There is a 10% excise tax in most cases if an employee who has not reached age 59 pulls their money out of a plan. Retirement benefits, of course, paid from a qualified plan are included in your income, but they're not subject to FICA and FUTA. So what that means is because if an employee pays into a 401k and they're receiving a pre-tax benefit by taking that money out of their wages now, but they're still paying FICA and FUTA on that. Once they take that money when they retire, they're not going to have to pay that Social Security and Medicare again, but they will potentially have to pay that income tax when they're in a lower tax bracket. Had that been a Roth payment or an after tax, they would be receiving that money essentially tax-free, which is the draw for some people that want to pay that, contribute that money now so that when they retire, they don't have to take that, or won't have to pay those taxes. Qualified annuity plans under 403A. An annuity plan meeting many of the same requirements as a 401A pension and profit sharing plan regarding vesting, participation, contribution, benefit limits is a qualified annuity plan under 403A. So make sure that you're paying attention to those glossary things, because there will be questions on just, do you know what the meaning is type thing. Employer contributions to a qualified annuity plan are not included in wages and are not subject to taxes. The ERISA requirements. The Employee Retirement Income Security Act of 1974, or ERISA, is a federal law that sets minimum standards for qualified pension plans in private industry. ERISA does not require any employer to establish a qualified pension plan. It only requires that those who establish plans must meet certain minimum standards. The law also does not specify how much money a participant must be paid as a benefit. ERISA also guarantees the payment of certain benefits through the Pension Benefit Guaranty Corporation, another item you'll have to know, a federally chartered corporation. If a defined benefit plan is terminated, if an employer closes or the plan itself is terminated, that's where those funds are guaranteed to be paid to the employee. Okay, qualified versus non-qualified plans. A plan is qualified if it complies with the provisions of the 401 of the Internal Revenue Code. Qualified plans include your profit sharing, defined contribution, defined benefit, and the popular 401k plan. Essentially, qualified plans must be in writing and communicated to employees, be established for the exclusive benefit of employees or their beneficiaries, be non-transferable and non-forfeitable, must satisfy the rules related to eligibility and minimum vesting of employees' interest in the plan, and most importantly, must not discriminate in favor of officers, shareholders, or highly compensated employees. However, benefits can vary with length of service. So that would not be considered a discriminatory style. Non-qualified plans, unlike the qualified, they can be discriminatory. They're typically for a public sector employee, but they can be discriminatory for those highly compensated employees. And this is an item, this table is something that you would definitely want to pay attention to and know those limits as they do change each year. For the catch-up, which we did not talk about the catch-up, but when you have an employee who reaches particular age, which the age I don't believe will change, but you never know. So pay attention to when that catch-up limit is allowed. So an employee in 2020 who is also allowed to have the catch-up limit, they can contribute to their plan $19,500 plus $6,500. They would get both of those amounts. Some employers will provide a 457 on top of their 401k so that those highly compensated employees, or the ones that they can discriminate with, they can put in the maximum in their 401k and then continue contributing. It won't prohibit them if they then start contributing into that 457. Pop quiz. An employee earns $970 semi-monthly, defers 13% to a 401k plan. Calculate any federal taxes that must be withheld from that 401k deferral. Correct answer is $9.65. Under this IRS rule, an employee contributes to a 401k. The amount an employee contributes to a 401k plan is not subject to income tax, but is subject to Social Security and Medicare. Deferred compensation regulations. This is the piece that gets a little sticky sometimes. An increasingly popular deferred compensation plan is called Cash or Deferred Arrangement, or CODA. This allows eligible employees to have their employer contribute part of their salary to a plan rather than receiving the salary in cash. The amount that's contributed is pre-tax, which reduces the employee's taxable income. The contributions, as well as money earned from investing them, are not subject to federal and, in most cases, state income tax until they're withdrawn. Key there, until they're withdrawn. To qualify as a CODA, a plan must meet certain requirements under 401k. For that reason, CODA plans are generally referred to as 401k plans. The plan is usually made available to employees through a salary reduction agreement, under which the employee agrees to a reduction in salary or a deferral of future raises or bonuses, and authorizes the employer to contribute this amount to the plan. Contribution limits. The maximum amount of salary that an employee may elect to defer or have contributed to a 401k plan is $19,500 in 2020. It's generally indexed annually to the next lowest multiple of $500. I don't think that question typically comes up. Catch-up contributions is when the IRS issued regulations implementing the requirements applicable to retirement plans, providing certain employees the ability to make up contributions. The eligibility for those catch-up contributions, if the eligible individual has to be age 50 or older, or the participant will reach age 50 before the calendar year that you're working with. This means all participants who will reach age 50 during a calendar year are treated the same age beginning January 1, whether or not the participants survive to their 50th birthday or terminate employment during the year. So it really
Rebecca?
doesn't matter. You're going to count their age as of January 1 as the oldest age. So if you have an employee who's going to reach age 50 in November, they can essentially be contributing that catch-up limit that whole entire year.
Can you move forward one slide, please?
Sure. Oh my gosh, I'm so sorry. Thank you. Elective deferrals made by a catch-up eligible participant are treated as catch-up contributions if they exceed any otherwise applicable limit. So what that means is if the employee is age 50 or older and they say, I want this as a catch-up limit, well, if they didn't reach that initial 19,500, it really doesn't matter. It's a moot point that they were age 50 or older. Under the regulations, your catch-up contributions are not taken into account in applying otherwise applicable limits to other contributions or benefits under the plan offering catch-up contributions under any other plan for the employer. For example, catch-up contributions are subtracted from the participant's elective deferrals for the plan year prior to determining the participant's actual deferral percentage for purposes of ADP testing, which is the annual testing that happens to make sure that a plan is operating under those ERISA guidelines. Your examples here, we'll read the bottom one. Employee Pam is 55 years old, earns $35,000 in 2020 and defers $26,000 to her employer's 401k plan, which her employer would match dollar for dollar for a matching contribution of $26,000. But Pam's total contributions are limited to $35,000, thus also limiting her employer's contribution down to $9,000. Pam's elective deferral of $26,000 is the limit for individuals over 50 years of age in 2020. Pam cannot make an after-tax contribution because it's a pre-tax plan. Your holding period for elective deferrals. Employers are required to transfer elective contributions to qualified defined contribution plans as soon as they can be reasonably segregated from the company's assets. For plans with fewer than 100 participants, the employer has a safe harbor of 7 business days to get those contributions into the employer's account. So once you process payroll, essentially you have 7 days maximum to get those in the monies that you have deducted from the employee's checks and deposit that into your deferred compensation plan, where that is then dispersed to the employee accounts. Department of Labor allows a maximum holding period for a 401k plan contribution to be the 15th business day of the month following the month with which the amounts deferred would have been paid to the employee. Employers that cannot meet the deadline have an extra 10 business days to deposit the contributions, but they must provide reason for the delay. This can be really, really tricky and unfortunate for those that cannot meet this. I've had some experience with that, and you get some major penalties. I've seen the penalties that come from that. An automatic 401k enrollment. You hire an employee, you say they're automatically eligible to contribute, or you force contribution. Automatic contribution arrangement is a default election that applies in the absence of an affirmative election by an eligible employee. An employee is treated as having made that election to a specified contribution made on the employee's behalf under the plan. So essentially, instead of receiving those enrollment forms, you're saying Joe Smith is walking in the door, is eligible, and he is going to contribute certain bottom line percent. Default election versus affirmative election. The default election deferral percentage ceases to apply to any eligible employee when they make an affirmative election, either opting out or selecting something alternate. So if you say all employees start out by contributing 1%, and the person turns in a form that says, no, I don't want to contribute, that default election no longer applies. Or if they say, no, I want to contribute 5%, again, that default no longer applies. Employees certainly have the option of withdrawing their election. I would consider some education for that, which we learned in fringe benefits, that you can educate your employees without them having to pay tax on retirement benefits. So withdrawal election, an election to withdraw contributions that were made under EACA must be made within 90 days of the first elective contribution. So an employee says, oh, I just decided I did not want to do this and I'm no longer going to participate. They also forfeit their employer matches. Most likely in a lot of plans, they would also end up having to forfeit any interest and things like that, depending on the type of plan. Excess contributions. Excess contribution and aggregate contributions are treated as gross income in the year the distribution will be taxed. Your tax treatment of 401k plans. Employee elective deferrals and matching contributions to qualified 401k plans to applicable contribution limits are not wages subject to federal income tax withholding. Federal income taxation is deferred until those funds are actually received or distributed from the plan, meaning retirement, separation from employment, disability, what have you. Employee elective deferrals are subject to Social Security, Medicare, and FUTA. Employer matching contributions are not subject to Social Security, Medicare, and FUTA. Employers should also check the states where they operate for any different treatment under state or local law regarding those income taxes. Your reporting requirements. Forms W-2, your 941 and 940. Your elective deferrals and employer matches to 401k are not considered wages subject to federal income tax, which is box 1 on your W-2. Elective deferrals must be included in box 3 and 5 for those Social Security wages and Medicare wages. And again in box 4 and 6 for any Social Security and Medicare tax that was withheld. Elective deferrals, including catch-up contribution, must be included in box 12, code D. That's important. Make sure you know that. Box 13, labeled retirement plan, also must be checked. Your 941, an employer does not include the elective deferrals or employer matching contributions online as taxable wages. Your 941 needs to match that box 1. Elective deferrals are included on lines 5A, column 1, and 5C, column 1, as taxable Social Security and Medicare. Again, because you're noting that on the employee's W-2 for those Social Security and Medicare wages, you also need to notate the employer Social Security and Medicare. Form 940, the deferrals must be included in Part 2, line 3. Roth contributions. 401k plans may permit employees who make elective contributions to designate some or all of their contributions as contributions to a Roth IRA or individual retirement account. The combination of the Roth 401k, elective 401k deferral, and catch-up contributions cannot exceed the $19,500 or $26,000 if they are eligible for catch-up limits in 2020. The Roth contributions to a 401k must be designated by the employee at the time of the deferral election, must be included in the employee's wages subject to federal income tax, Social Security, and Medicare taxes at the time the employee would have received the contributions, must be included in the deferrals used for the actual deferral percentage or ADP discrimination testing, must be maintained by the plan in a separate account, and must be reported as Roth 401k deferrals on the form W-2 in box 12 with the code AA. This is crucial because, as I said earlier, when an employee designates their information or their contributions as Roth, they're paying that tax now. Then when they retire, those distributions there's no tax taken. So a lot of people try to kind of play that risk game of what kind of tax bracket or where do they think that personal income tax amount is going to be by the time they retire. And they either take the risk and do pre-tax now in thinking that down the road their personal income tax amount is going to be less and they'll potentially pay less in federal tax, or they pay it now so that when they retire, they don't pay any tax on it. None. We'll do our last little pop quiz today. Which of the following statements is true about 401k plans? Employers must match employee contributions to a 401k plan. Employee contributions to a 401k plan are not subject to Social Security and Medicare tax withholding. Contributions to a 401k plan are subject to federal income tax when deferred. A 401k plan is designed primarily for employees of tax-exempt organizations. Again, which of the following statements are true? It is C. Contributions to a Roth 401k plan are subject to federal income tax when deferred. When deferred, also think of when the contribution is made. Under the IRS rule, employee contributions to a Roth 401k plan are subject to income tax at the time of contribution or defer, and are subject to Social Security and Medicare taxes. 403b plans are designed for employees of tax-exempt organizations. 457b plans are designed for employees of state and local government plans, and employers are not required to match those employee contributions of a 401k plan. So those end three statements were telling you why the other question or the other items were not true. I feel like we kind of rushed, but I know we have to get to the actual chapter discussion that's coming up in what, 4 minutes? 2 minutes?
It starts at 11:45.
Okay, so we do have a couple of minutes if there are questions at all.
I don't have any questions. Great job. Thank you. I appreciate it.
I don't think I do either. Yeah, thanks for presenting that.
And it's kind of really interesting that our chapter meeting is on deferred comp and retirement plans.
Oh,
so
excellent.
I think it's a great
guys. Good planning.
It was, hey.
Yeah, we absolutely meant that.
That is fantastic.
It is.
That is fantastic. Well, then maybe we should give everyone this last couple of seconds to have a quick break before we log back into the chapter meeting.
Thanks, Rebecca. We'll see you tomorrow.
Yeah. Thank you.
Thanks.